Welcome. I just want to say another great topic for today. This is Lauren Fogelman with Business Success Solution, showing accounting firm owners how to be able to double their income working half the time. And today's topic is valuations for accountants, how to go ahead and build, measure, and maximize your firm's value. And I am going to be meeting and talking about this with Ben Towne. He's a CPA and founder of Assurant Advisors, as well as Towne Advisory. So you are in the right place if you want to understand what really drives your firm's value. Avoiding some of those costly myths that you think are going to make a difference, but it actually isn't going to be as beneficial as you think, and knowing when and how to start planning your exit or succession. So go ahead and be ready to take some notes because Ben is very generous in sharing. But before we get into the conversation, just a little bit about Ben. Ben Towne, CPA, is the founder of Towne Advisory. It's a firm specializing in business valuation and exit planning. He's created the Exit Builder. It's a program to help firm owners guide transferable value and prepare for smooth, successful transitions. Ben and his team actually guide owners in assessing readiness, identifying gaps, and creating strategies to maximize their firm's worth. And he also hosts the Max Value podcast, where he interviews operators, advisors on building sellable, high-value companies so that you can really get as much from it as possible, and it is done in a strategic way. So anyway, if you want to learn more about Towne Advisory, you can go to Towne. It's TOWNE advisory.com. And Ben, thank you so much for joining me today.
Well, thank you, Lauren. And I will say it may take us a minute to get the episode out, but thank you for joining us on Max Value as well. And thanks for that shout out. So we'll let everybody know when that drops.
Perfect. And before we go into really the interview, I am always interested in hearing, how did somebody get to do what they're doing? So how did you end up specializing in valuation?
Gotcha. I am a CPA by training and personality, and the beginning of my career was really at a mid-sized firm in the San Jose area. Really great, old school firm. Did tax and audit and all the normal things you do at a smaller to mid-sized firm. And I just found that those weren't my passion. I was never going to be passionate enough to be as good at it as I wanted to be. I was good at it, but not ever going to be, the top dog. So I dabbled in family law and business valuation and forensics, and just found that business valuation was my lane. So started up the department there, and eventually, well, about 13 years ago, started up my own firm.
And one thing about CPAs, they are great with numbers, better than average, that's for sure. And then they have the tools. But does that usually lead to them being able to handle valuations as well?
Yes and no, but I'll say the start point should be no, only because it's a very different type of exercise. When being a really great accountant, being a good CPA really means that you're effective and really versed with kind of the building blocks. That doesn't necessarily mean that you're going to architect a bridge, right? So when uh, when an accountant starts dabbling, like I started out with, most people do
Mhm.
start out this way from the accounting side with business valuation. You're looking at the blocks, trying to figure out how they fit together in terms of a cohesive view of a business's value. So if you get the training, if you get the really change in mindset, because valuation is a forward-looking process, not just historical
Mhm.
looking. Like a lot of times you are doing a tax or auto a project, that kind of thing. Uh, and you get the experience at looking at the particular type of asset, the particular business that you're looking at all the time. Then maybe you can do business valuations, and there are standards. The AICPA has standards that I follow as a CPA in order to make sure we do a good job. If you can meet those standards, perfect, then do it.
And so one of the things I hear you talking about when you're mentioning this is that it's forward looking. It's a trend that is actually going through the entire profession is about not just being on the
Mm.
compliance side, but the forward looking side and being able to apply the numbers. So it might be that more and more CPAs are actually finding that this is something new and open to them as they're moving in that advisory direction that they never might have even considered before.
I think so. I think that's a really good thing, and there's a lot of different ways that that consult can come into the normal relationship that a CPA has with their clients. So thinking like, hey, let's do some strategic CFO type work with that client, um, to exit planning, to business valuation. As long as you have again, the proper experience and meet the standards, I would absolutely think that's a great idea. I don't mind a little bit more competition out here. There's too much work. Please come.
Mhm. And one of the things I'd like to really do right off the beginning is maybe let's all get on the same page as far as what it means. Because value, that word itself is so subjective, and valuation might have a variety of definitions. So, how do you look at those two things?
Gotcha. So philosophically, right, we have different kinds of value. Like you said, what does that actually mean? I mean, there's emotional value to things. And I'm not, trying to be coy there, because there are very specific economic definitions of value, like fair market value in in the Internal Revenue Code, and fair value for financial reporting, those sorts of things. But at the highest level, what is value? You can actually define it really simply. I mean, kind of page one of Finance 101, if you will. Uh, if you look at value equaling your expected cash flow or expected benefit divided by or compared to the risk minus growth. And that's the underlying formula that drives basically every modeling of valuation. You could do a little algebra and turn it into any of the models that we use. It can derive back to that. So really, it's those three variables: uh, benefit or cash flow, risk, and growth. And when we're doing the process of valuation, it's all about investigating the company, investigating the situation to understand what the internal and external factors are on that business to help estimate those variables and then get to, right estimate of value.
And I just want to make sure that I got the equation right. Value equals expected benefit or cash flow divided by risk minus growth. Is that correct?
Right. Risk minus growth is the denominator.
Okay, I just wanted to make sure that I got it because I'm taking copious notes on learning from you every single time that we have a
Oh, thank you.
conversation.
Same.
And okay, accounting professionals, CPAs, they live by reports and they might really look at valuation as just being one more number on a report. But as a result of doing that, they might be overlooking something. So what could they be overlooking when they just see it as a number on a report?
Well, it is definitely the difference between compliance and being a true consultant, with your client. So the number is important. That's why we're doing the whole process. You can pick that up and put it into your tax return, or you can pick it up, put it on your financial statements, whatever you're doing with it, or of course, actually negotiating a deal. But that actually underlies the kind of the yes and answer here, which is you have the number, but what does that number really mean? And that can be determined by, well, why did we do this thing in the first place? If we're trying to negotiate a deal, or, help your client negotiate a deal, great. But that's a very different type of number and different rules that we apply, say, compared to a gift tax based number, uh, where we're, using all the appropriate discounts, et cetera, et cetera. But hey, if I'm coming back to, we're going to do a transaction, let's talk about how we can influence that number in terms of what are the things we highlight? What are risks involved in this, not just in the number, but also in the deal. So there's a lot around that number that can be super important. And sometimes you just need the number.
And one of the things I want to get a little bit more into the perspective from an accounting firm owner, are there things that they could be doing that would increase the value of their firm when they're getting ready to sell it?
Yes, absolutely. So first off, having an idea of who you're selling it to is going to really identify what gaps you need to fill exactly. But maybe something a little bit more actionable. One of the lowest hanging fruit pieces is always process. So many firms that I see and work with just lack process. So somebody coming into your shoes doesn't have the institutional knowledge you have. So how do you give it to them as quickly and effectively as possible? And it's not just you, it's everybody in the team, such that you have a way of doing things in your firm that's consistent, that's standardized-ish. I mean, we're all artists in a way, but we also need to make sure that we're doing things in a way that is transferable. So I think focusing on anything where you you can drop the mic and leave, and you can do it either by, leaving a mess behind you, or you can do it by having a nice, smooth transition and process, excuse me, a written process is often a really, really good way to start doing that.
I'm going to ask one more question around that. Is
Yeah,
there a difference between firms maybe that are rural as opposed to metropolitan
that's
when it
interesting.
comes to valuation or being appealing?
Now, that's a really interesting question. So it, I think that it comes down to the pool of buyers who are going to be interested
Hmm.
in a large part. I mean, there's internal and external factors, right? So internally, there is the types of businesses or and types of clients that you are serving. And so those that maybe there's a limited pool if you're in a rural area geographically and stay there. Maybe there's a talent pool question that you have. Maybe you have to go outside that area to get talent. Could have a whole conversation on that one.
Hmm.
But uh, the real thing is, yeah, I live in San Jose. There are, regional firms who may want to come into San Jose. Therefore, they might want to buy a San Jose firm, for example. Probably not as frequently would you have somebody want to go into, say, I don't know, Hollister or as a more outlying
Hmm.
area compared to the metro
Right.
area. So that is definitely a consideration. You're probably not going to have as much interest from a PE firm, for example, private equity firm. But there's I wouldn't lose hope if you're not in a major metro area. It's just a little bit of a different flavor of exit potentially.
Hmm. Okay, so then some of the things that you were talking about is you want to maybe think about who it is that you might be selling to. It could be someone internal, it could be someone external, it could be someone you know, someone that you're working through a broker. There's so many different ways to be
Hmm.
able to do that. And one of the things is to think about having a process in place, standardization so that it's transferable. You're no longer keeping it all in your own head because that IP is part of what makes your firm valuable is if they can continue to deliver same level of service or even a higher level of service. And I would think that being able to get the process out of your head means that it allows someone else to step into your role as well, as opposed to you being the only one that can do all these things. So you want to make it
Absolutely.
more like McDonald's to a degree.
Right, to a degree. And I think taking a page out of McDonald's book in a certain sense where uh, you know, you can come along and help with identifying, well, how is everybody pricing things and getting more scientific about that, making sure that, you're really optimizing the your ability to make profit because, from my perspective, exit planning, this is the, part of the upfront before your transaction. The exit planning is really just helping you make a good business. And so bringing somebody like you in to make sure that you're making the most profit with doing the least amount of work is a good thing. Gives you a good business today and makes you an attractive business to buy. Um, you can definitely think of it that way. I liked your when you were saying your intro, get what was it? Get twice as much
Oh,
productivity with half
double
as much
the
effort.
income working half the time.
Yeah, if I'm doing the math right, that's four times. So that I think that's a good goal.
So one of the things that you have is your system called the Exit Builder. And can you kind of explain what that is and how it would benefit firm owners?
Absolutely, thanks. So, Exit Builder is our trademarked process to work with business owners and their teams of professionals. Because it's not just us. I mean, we specialize in business valuation and the business aspect. But really, when you're looking at an exit, you're looking at three different components. You're looking at the business, which is oftentimes the biggest asset of a professional. You're looking at their personal well-being as well, and you're looking at their financial situation. Now, I'm not a therapist and I'm not a wealth planner, but we can work with those people in order to identify who are the stakeholders, what is going on, uh, what is really your vision for that exit, so we can move all of those pieces together towards that exit. And we organize this all in what I call four doors on the way to getting to that final exit. We're focusing on the individual or the individuals who own the company, not just the company. So it's a little bit of a different perspective, looking out for you essentially. We look at, the discover phase where we try to understand who are the stakeholders, what is it that you want, what do we got right now in the business valuation, because we do that in that phase as well. And what is the vision? What do you want out of an exit? Because an exit, successful exit, looks different to all different people because we're again focusing on the person, not just XYZ business with an owner who wants to get out of said business.
Hmm.
Second phase is orient. That's really okay. Now that we know all those things, what's the plan? Are there gaps between our vision and where we are today? If there are significant gaps, then we go on to the third phase, which is optimize. For us, particularly, that's looking at the business. That's where maybe we'd bring you in. Uh, Sometimes other professionals as well. Especially for the financial perspective and the personal perspective. How do we get readiness for the business and the individual? A lot of times we can move the needle in terms of increasing business value in that phase, if that's part of the plan, because you may or may not need that or want that. And then the last piece is the realize phase, where we look at actually getting the transaction done. So depending on what type of transaction, which we figured out in the orient phase, and of course we've been reorienting all the way through as things change, if they change. But at the realize phase, that's either getting a broker involved, that could just be getting a an attorney involved. You're gonna have an attorney involved anyway, period. Uh, but if you're doing an internal succession, that may not involve a broker. So getting the right people involved for that process at that time is what we do then. And hopefully the very last step is you're off to the sunset.
And part of what I'm hearing from you about the exit builder process is that it's a very holistic approach where you're looking at the individual, which would be the owners, because it's usually their baby. They built it from the ground
Yeah.
up, and there's a lot of attachment to it in many ways. They want to make sure that it's a good handoff. So there's a discovery phase about that and understanding what a successful exit looks like from their perspective. And then you're going into the orient phase where you're figuring out the gaps between where they are now and where they want to be as far as exit, and maybe doing some things as far as prep work to get ready to sell the business. To me,
Hmm.
that sounds similar to when you maybe stage a house before you put your house on the market, or you do all those renovations to it, and then you go
Right.
ahead and put it on the market. So that's what I'm hearing there. Stage number 3 is optimize, where it's the readiness for the business itself, the entity, as well as the individual, because there definitely is some transition as someone's ready to exit their business and release themselves from it, or pass it forward. And then the last one is the realize phase, where you're actually in that action phase of the transaction, and it's not only about you, it's really about the team that you have with you in order to be a successful handoff that is in the best interest of everybody. Is that pretty much what I have correct?
Yeah, yeah, that's pretty much it.
And about how much time, ideally, would you say it takes someone to go from stage one to stage four?
It really depends on what somebody wants and their existing level of readiness now. Uh, we can, we provide a readiness survey if your uh, listeners are interested in that. But it depends answer, unfortunately, like so much in our
Mhm.
business. We've definitely had clients that really just need the business valuation up front and then a little bit of help at the back end with Realize because they don't really need the stuff in the middle. And that's fairly common, especially for businesses that are pretty squared away. You have good financials, have a good, I mean, silly as it sounds, but have a good understanding of the org chart, have a good understanding of, a process, etc and or maybe already have a successor identified. So then it just becomes, okay, you know what process you want, therefore let's just be a
Mhm.
guide so we don't step on any landmines in between here and there so you get to that exit that you've already planned. That's great. That can happen between, 3 and 6 months, generally speaking, at least to have the transaction done, even though there's
Mhm.
probably a tail to it, as you know. Um, all the way to maybe 2 years, especially if there are some things that we need to do in the optimize phase. That's really the big bogey is, it could be nothing all the way to fairly significant amounts of work that you want to try. Hey, we need different people on the team in order to make this be more self-sustaining aside from the owners of the business, the business runner or runners, that sort of thing. So it can be kind of a wide range of needs and wants. It has to be the intersection of both.
Okay, and so valuation multiples is something that is talked about a lot.
Hmm.
And there are a lot of myths. There's a lot of things where it's unknown territory for people that want to move in this direction, but they are so unsure. So anything that you see as a myth, and why some of these myths could actually lead to costly mistakes?
Right. So I think of multiples. Well, firstly, I think of them as pricing by analogy.
Mm-hmm.
So to the extent that you are using a similar basis to price by analogy, that's great. But a lot of people don't account for differences. And that's totally uh, that's something that we absolutely do. Hey, are you looking at a different type of firm? Or is it an audit firm or a tax firm or a consulting firm? Those can be quite different, and so you can't use this exact same analogy for each one, or the mix of services, et cetera, et cetera. The second way I think of multiples is as a fraction. So when somebody says like a price to sales multiple, think about, okay, the price is the price compared to sales divided by sales. So actually pull that apart. Make sure you clearly understand what's in the numerator and denominator of that equation, because that's where you actually can literally calculate the value. And one of the big mistakes that I see, even with CPAs, is first off using a rule of thumb, which kind of can be accurate-ish for if you say average everything, and nobody's average everything, and also not really understanding what is going into each part uh, of the fraction clearly, and so that can lead to mismatches and leads to winners and losers in that, and oftentimes accidental winners and losers. You're not really even doing yourself a favor all the time.
So it sounds like there's the obvious factors you need to consider, but then there's some variables underneath that you might not think about as you're moving this direction if you're more on the outside, just kind of winging it, as opposed to working with someone who really is an expert at this. So it sounds like without having all the information, you could hit a home run, but then you could totally strike out as well.
Right. And I mean, as we know, business is harder to do than, than a lot of people think. Uh, so, if there are variables that make it much more certain, and this is going back to that equation, right? Much less risky. So anything you can do to
Mhm.
lower risk increases value. Anything you can do to increase growth increases value. Anything you do to increase cash flow increases value. You can think of cash flow in terms of profit. So there's a lot of firms out there who would say, yeah, yeah, well, let's get, one times our sales, our revenue. Fine, but that's going to look very different. Your multiple should look very different if your profitability is different than another similar company. So if you have two $1 million firms, but one has 20% operating profit and the other has 30% operating profit, I'm not going to pay the same amount for both of those companies.
Mhm. And getting to my last question is
Yeah.
that there's a lot of different ways of thinking about exits. Some theories are that as soon as you open your business, you ought to be planning for your exit. And then most people, that's not where they're at. They're thinking about it maybe possibly 10, but 5 years, maybe even less than that before they get ready to exit. So when do you recommend is the optimal time for a firm getting ready to start preparing to move in this direction, even though they might not be ready to put their business on the market yet?
Right, right, right. It is it is difficult to be thinking of that kind of thing, especially early on when you're in survival mode all the time. And I think most businesses run through that phase at some point. The right point is all the time because and let me get more specific on that, but you are going to exit your business, period. Whether you plan it or fate plans it, you're not going to be running your business forever. So, first off, especially if you have partners, you need to do it day minus one. You need to be looking at, what's in our agreements, what do we put in our buy sell clause or agreement, a separate agreement, to make sure that, hey, look, when something happens, a triggering event happens, a departure, a death, a disability, a divorce, you just have a roadmap because something's going on, something is happening there, and usually it's pretty stressful, and it's gonna be stressful on the business. Make sure you have some kind of pre-agreed upon plan because things can go awry very, very quickly. Nobody wants to think about that in the excitement of, getting together and doing a business venture, but you have to just take a second. This is actually for your partner's good. So the more you care about your business partners and your business team, the more you should do this. And then most people don't, but you probably should be looking at your exit plan and including your buy-sell agreement probably once a year, once every other year, at least on a periodic basis. So at the very least, you remind yourselves what's in that darn thing. And as far as, truly, truly getting to the brass tacks of exit planning, getting towards your exit, uh, start thinking of it at least 3 years in advance so that you can really put that line in the sand. What happens too often is somebody says, "Yeah, I should get out of my business. I should sell this thing. I should whatever," right?
Mhm.
You're kind of musing about it over a beer or something, but you never actually do it. It's always just one more busy season, one more busy season, and suddenly you find yourself, at what I'll just pick an age, at 78, and you never made any plans, and you really feel like, man, I should have made some plans about 5 years ago.
Ben, I just want to say this has been a great conversation. As I mentioned, I learn from you every single time we meet, and that I believe this is such an important topic because it's so easy to delay, postpone, and that the more that we are actually proactive on this, the better someone is going to be for when they actually get to that point, as opposed to having the scramble of trying to get all of the things out of their head. And now they're creating processes and systems and everything like that, in addition to their regular workload. So I appreciate you being an advocate for firm owners who are looking to sell and how to be able to do it strategically. Some of the things that we did talk about is understanding what really drives value for firms, looking at avoiding some of the common valuation myths, and thinking about exit or succession before you are actually ready to implement. So if firm owners wanted to connect with you, learn more, or take advantage of that assessment that you mentioned earlier, what's the best way for them to connect with you?
You know what? Just send me an email, btowne, Towne, at towneadvisory.com, or go to our website, towneadvisory.com, and there's a, contact us. You can hit me up for a free consultation. I always consider that just scoping. So no big deal. I'm always happy to spend a half hour, an hour with anybody talking through whatever issue. And of course, we have the exit readiness, the survey for you too.
Perfect. Thank you so much for the engaging conversation, and for everybody that joined us. This is Warren Fogelman with Business Success Solution, showing accounting firm owners how to be able to double their revenue working half the time.